Hello, I'm Attorney Louis Haskell, and I am at the Red Water Lily Farm in Nakhon Nayok, Thailand. And as you can see, the water lilies are starting to open up today, this morning finally. It was cold this morning, so they were a little slow getting going. And I want to talk today about some of the provisions in the new tax law that relate to small businesses. So-called pass-through entities, because this is, to me, perhaps the most important change in the tax law. It's the one that could potentially have the biggest impact on me personally. It actually creates some opportunities for people to be thinking about their legal form of their business, which is always fun for me. But also, it's just where the most money seems to be involved outside of the corporate sector. In other words, on the individual side, there's a lot of moving parts. A lot of people will get tax cuts. I'm not sure how big they are. Here I know exactly how big. The thrust of the new law is that for so-called pass-through entities, they can exclude up to 20% of their taxable profit from their individual tax returns. So if a business makes $100,000, whereas under the old law you would be taxed on $100,000, now your tax liability would be reduced to $80,000 because 20%, in this case $20,000, is excluded. And pass-through entity is really quite broadly defined. S corporations, LLCs, partnerships, some trusts and estates, and even sole proprietorships. People who are simply filing their taxes on a Schedule C are considered pass-through entities for the purposes of this discussion. So pretty much all small businesses are included in this. There are, however, exceptions. The most brutal one, especially for people like me, is the exclusion of what I call personal services businesses. And that specifically includes lawyers and accountants. It would include hairdressers, manicurists. It would include athletes and actors. Most business consultants, or really pretty much all consultants in general. Interesting enough, architects and engineers manage to get themselves excluded from this definition. But for a lot of us, it sets a cap on how much we can make. And basically that is, for a single person, $155,000 of taxable income. For a joint filer, $315,000 of taxable income. After that, that 20% exclusion begins to phase out. For a married couple at $415,000, I believe, it's completely gone. So if you're a particularly successful accountant or lawyer, it hits athletes and actors and actresses really hard. If you're particularly successful at these things, you lose this benefit. But for a lot of folks, this 20% write-off is quite nice. For those outside of the personal services realm, there's a second limitation, and that is your 20% exclusion is capped, well, for most businesses at 50% of their payroll. So if I were not a personal service business, for example, this would not be a problem because my payroll is usually more than my profit. Actually, I think it's pretty much always more than my profit. So 50% of my payroll would be more than 20% of my profit, so I'd be okay. Where this 50% of payroll can be a huge problem, however, is for real estate businesses. My wife and I have 16 Pine Street, and 16 Pine Street has no payroll, and yet this new law is designed to cover 16 Pine Street as well. And so there is a second way to calculate the cap. And that is basically, for a situation like that, 2.5% of what you pay for the building. Let me get wonkish for just a moment here and say that it's 2.5% of the depreciable basis of the property that is still being depreciated. So what that means basically is that if you bought a building for $1 million 40 years ago, well, that building's fully depreciated, and so you don't get anything for it. But if you bought that same building 10 years ago, and you're therefore still depreciating it, basically your cap is, the cap on your exclusion would be $25,000, which is 2.5% of $1 million. Now keep in mind, you'd also still be depreciating that building, so, and that $25,000 is the 20% exclusion. So you would need $125,000 of taxable profit before the exclusion became an issue. And that is, and that's frankly not bad. Now I suppose if you bought the building for $1 million, 20 years ago, and the building's now worth $5 million, but your depreciable basis is still $1 million, that could create some issues and maybe some games you want to play. But for most people, that 2.5% cap is not going to be a problem. Now there are other issues where that depreciation may be an issue. For example, when we bought 16 Pine Street 17 years ago, we put in a number of new HVAC systems. Well, those are now fully depreciated, so we get no benefit for that. But what this does do is create some interesting issues for a lot of businesses and for those of us on the real estate side, into where you want to start expensing things and where you want to start depreciating things. And it's going to be interesting going forward to see how this plays out for various clients. In other words, I put a lot of time and effort into learning the tricks for how to expense items in real estate that would technically be considered capital expenditures. The IRS has all kinds of interesting new actually the regs are only a couple of years old, that allow a fair amount of expensing of what could be characterized as improvements. At this point, it's not so clear if that's going to be what you want to do anymore. It's very, I think, client-specific. But there may now be some advantages to depreciating these things rather than expensing them. Similarly, you might not want to be so aggressive about depreciating things. In other words, it might be well to characterize some things not as equipment, but as, improvements to land and letting that depreciation run, because, you get to write off 2.5% of that every single year that it's going, on top of getting to depreciate it over the years. As I say, it creates some interesting issues that you really do need to sit down with your tax preparer or accountant or lawyer and discuss. But that is, in a nutshell, what's going on with this pass-through entity deduction. It's an exciting development, and I'm really looking forward to working with it. Thank you.